Hello and welcome to Shortcuts with Julian. This is Julian. Today we're going to begin right at the beginning. Let's say you're a retail trader, you've learned a little bit about what it means to go long on a stock, to buy and then sell a stock. Today I'm going to teach you or start you on your journey to become a retail shorter. And today we're going to begin at square one, which is how to think about stocks like a shorter. Now, you've probably already gone through to figure out what a stock is, but just as a reminder, I thought I'd put this little presentation together. So let's imagine that we have a company. This is a private company that's about to become public and go on the market, and we're going to call it Rectangle Inc. Rectangle Inc. is represented by this large rectangle here. And this rectangle encompasses everything that the company does. It's got its machines, its buildings, its employees, and its product inside of it. Now let's say Rectangle Inc. is going public, which means it's going to go and offer itself out on the market, shares to individual investors, and it's going to chop itself up into little bits that you can buy. And let's say they offer it for $1, and here's a little bit over here. This black square here represents one share of Rectangle Inc. So let's say we own that little corner there. Let's say that corner over there is $1. This is one share. So this is one little piece of the larger company. Simple, right? That's all that a stock is. Now these individual shares, they're on the market, and the initial person has bought the share, and they now have told their friends, and their friends are beginning to buy shares inside of Rectangle Inc. And that is going to drive the price of the share up. Now, after a while, some people decide to take their profit from the share and they start selling the share, and that drives the share down. This is what a daily action on the market is. This is buying a share, which makes the price go up, and selling a share, which makes the price go down. So this is kind of what the journey of a share looks like. Now notice that the share price moved all over the place. It bounced up when somebody bought it, it went down when somebody sold it, and this is what trading action is on the market. So I've walked you through what 90% of retail traders do, and that is to buy stocks and then sell them at higher prices, hopefully, or the ideal hope of what a retail trader does. I'm now going to walk you through what 10% of retail traders do, and this is actually more common for professional traders, so people who work for hedge funds. They actually use this tactic more often, and that is shorting a stock. So let's take a look here. So this is the action, the daily action of one stock. Let's say it's Rectangle Incorporated, just for our efforts here. And you'll notice that sometimes it's bought and the price goes up, these green marks here, and sometimes it's sold and the price goes down, these red marks here. Now, if you're shorting a stock, you don't own the stock. Now, let me explain what I mean there. So let's say you want to short Rectangle Incorporated, and you see a signal here. You see this red bar here, meaning that some people sold the stock and the price moved underneath this SMA line here. Now we'll explain what SMA lines are in another video, but let's just ignore that for the beginning here. And this right here is where you want to start shorting a stock. So when you short a stock, it means you think that the stock is going to go down in price. So right here, you put in an order that says sell this stock at this price. And that order goes toward your broker, and your broker will then lend you a share of, so remember that black rectangle or the black square, lend you a share of Rectangle Incorporated for you to have on loan, meaning that you don't actually own that stock, you just have a loan on that stock. Now what happens is the stock is moving down in price. Now, if you invested in the stock, meaning if you bought the stock, this does not look good. But if you shorted this stock, this is fantastic. This is profit. And right here, you want to end the short. Now, your goal is then to have the broker buy back the loaned share that you have taken, and they're going to buy it back here. Let's say it was here and it was $1 up here. Let's say here it's 75 cents down here, which means that you actually get to pocket that profit. You're selling it at a lower rate back to the broker, which means you pocket 25 cents. And that is your profit. That's what shorting is. You pocket the loss of the company. So it's kind of cold, and this is what some people would say. Some retail traders do commonly say that shorters are the worst people on the market, but it's a natural form of trading in that you are actually profiting on the fact that this company's share is not worth what it is actually being told that some traders might say it is. So that's what a short is. Now, I keep using this term investor and trader, investor and trader. And is there a difference between the word investor and trader? Sometimes when you're watching the news, they use those words interchangeably. Well, actually, there is a difference, and this is really important for retail traders to understand. So the investor, first off, is somebody who looks at a share of a company and doesn't worry about the day-to-day market movement. They see the stock moving up in the day, down in the day, and they're not concerned by it. They pay attention only to the intrinsic and fundamental position. So what do these two words mean? Intrinsic and fundamental. Intrinsic means the value that they themselves have calculated that the company is worth, or the share of the company is worth, and the fundamental is what the company actually is worth on paper. So if they were to liquidate right at this moment, meaning if they were to go bankrupt and sell everything off in this moment, this is how much they would get for their company, is the fundamental of the company. So investors only worry about the calculated price that they think the company's worth and what the company is actually worth on paper. So intrinsic is a future-looking word and fundamental is a present word. Now, they don't concern themselves with market psychology, so they're not worried about the day-to-day movements on the market. So they are someone who will who will buy their position, and they will just let it ride or just not look at it again until another future moment. Now, a trader is someone who is the exact opposite of an investor. They are concerned with market psychology, meaning that they're worried about what goes on, or they are not necessarily worried. They pay attention to what goes on to the market daily and the movement daily, and they profit off of this movement. And when it comes to fundamentals of a company, so what the company is actually worth on paper at the moment, they don't necessarily pay attention to that. So they won't have a problem with trading a company that doesn't make any money. They're actually more concerned about what other traders are doing on the market and trying to make a profit off of that. Now, you can have long investors and you can have short investors. You can have long traders and you can have short traders. And some traders will actually fluctuate between those two, and they're called scalpers or they're called movement traders. Now, I, as a shorter, call myself a short trader. Although I have, in fact, done short investing, meaning I've taken a position and I have then, therefore, let it ride until that company goes bust. Now, a trader usually follows signals and patterns on charts. Remember, I showed you that chart in the earlier chart with all the different squares moving up, the reds moving up, and then the greens moving oh wait, sorry, the green's moving up and the red's moving down. And this is what patterns and signals are. Now, there are many different theories about trading, and I'm not going to try and teach you one of those in this initial video here, but this is called signal or pattern trading when you're just paying attention to these sorts of movements. Now, as I said in the last video, a shorter can be both a trader and an investor. And here's a really good example about what I'm talking here. These are two very famous shorters. Right over here you have Steve Eisman, and over here you have Michael Burry. And they're famous because actually they were featured, or characters based on them were featured in a movie called The Big Short, which was about shorting the housing market during the 2008 housing crisis. Now, Michael Burry, right here, would be considered a shorter who is an investor, meaning he took a long position and said, okay, so this market is going to fail and these particular funds are going to fail, therefore I'm going to take out a short on them, and he actually held it for 3 years before he saw any profit. Steve Eisman, on the other hand, is a little bit of both. He's famous for taking trades on on many different companies and actually shorting them down, seeing that they're not profitable and therefore shorting them. But he also was an investor, a shorting investor, during the 2008 crisis. Now, to be a investing shorter, so a shorter who invests, it's generally not something you see a lot of retail shorters do. And the reason is you need billions to do it, because in the case of, say, Michael Burry and his shorts on the housing market, he had to have millions of dollars to pay the fees that are required when he was taking the loans out on those from the various banks that he was getting the loans on those funds for. So you don't see most retail investors, traders or retail people actually do investing shorts. Most retails are like this guy over here, and that's Steve Eisman. And in fact, Steve Eisman now, who no longer runs a fund, he actually does do a lot of retail shorting on his own right, although he's a pretty private individual. You'd remember him in the movie as played by Steve Carell. This character here was played by Christian Bale. So now we come to the big question. You've got all the backstory. So how does a shorter think about a stock? Shorters, first off, need to be nuanced. We can't think of something in a standard black and white position. We can't think of it just as this is a good company to buy, therefore I will buy a stock in it, and therefore I will let it ride. We cannot do that, because we are actually looking for companies that are not necessarily the best companies. So if you see a company that is the absolute best company, do not short it. Here's a good rule: never short a stock or company that makes money. And shorters, by the way, because of this, need to know the fundamentals. You need to know the company that you are shorting. Do not just short on patterns. This is how you lose money. So you need to first off know that the company you are shorting does not make money. You need to also know that the company that you are shorting is not working very well. It's not likely to make money in the future. You need to make sure that your short position is based on something that is going to be profitable for you. But they also need to understand market movement. They need to understand that trading can change direction and is not necessarily connected to the fundamentals of a company. So you need to know that this movement here may have nothing to do with the company, but you need to understand why that movement occurs. And you also have to be more in tune with the equity, so the share, than somebody who takes a long position. You need to be paying attention to every intricate detail of what this company is doing and why it is doing it. And on top of that, you also need to then make sure that you understand why traders are moving the stock in one direction and why the directions are moving like that. This is why most retail traders do not short, because shorting requires larger focus and larger amounts of tactics and will that most retail traders, frankly, they just don't have. And above all, shorters need to be controlled. You need to make decisions that are intent decisions. You need to make decisions that are based on facts and based on the underlying movement. So you never make a decision just out of fear or emotion. So above all, I'll say it again, shorters need to be controlled in their positions. So that's how shorters think about stocks. Shorters think about stocks in a different way. And if you want to get more information about how to become a retail shorter, by all means, go to my Patreon, which is patreon.com, shorting with Julian, and and you can actually join our Discord and meet and work with other retail shorters on a daily basis to learn about shorting, and you can get many different levels to do that. Also, give me a like or a thumbs up on this video to make sure other people can reach out and find out about shorting. And until next time, please, I remain Julian from Shorting with Julian, and I really do hope that all of your trading is profitable. Thank you.